Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5 in plain, educational language. I'm your host, and today we're examining an expert advisor called the adaptive serial correlation switch. This is a purely statistical approach. No classic indicators, no chart patterns, no support and resistance. Instead, it measures a single number, the lag-1 autocorrelation of recent price returns, to decide whether the market is currently trending or mean-reverting, and then adapts its behavior accordingly. By the end of this video, you'll understand exactly how it reads the market and manages risk. Let's get started. So what does this expert advisor actually do? At its heart, the adaptive serial correlation switch treats the stream of bar-to-bar price returns as a raw statistical process and asks one question on every completed bar. Is the market currently persistent or anti-persistent? In plain terms, when a move tends to be followed by another move in the same direction, we call that persistent or trending. When a move tends to be followed by a reversal, we call that anti-persistent or mean-reverting. To measure this, the strategy computes the lag-1 autocorrelation of the last 30 log returns by default, a single coefficient, written as rho, that always sits between -1 and +1 and is completely independent of the price scale. The sign of that coefficient classifies the regime. A clearly positive reading means the recent returns are trending, so the edge is to go with the latest move. A clearly negative reading means the returns are reverting, so the edge is to fade the latest move. And when the reading sits inside a small dead zone around 0, the strategy treats it as noise and simply stands aside. Because that coefficient drifts over time, the very same logic will trade with the trend in one market condition and against it in another. The strategy self-adapts to the measured behavior of the market rather than assuming a fixed directional bias. It runs on a single chosen time frame and is designed for liquid instruments such as major currency pairs, metals, or crypto. It suits a trader who is curious about a systematic, statistics-first approach and who understands that every strategy, including this one, carries real risk and will experience losing trades. This is educational information only, not financial advice. Let's walk through the exact logic step by step. The expert advisor acts only once per newly closed bar, so it isn't reacting to every tick. On each new bar, it first checks that it has enough history, the correlation window plus the impulse span and the ATR period, before doing anything. First, it reads the average true range, or ATR, of the last closed bar. ATR is a simple measure of recent volatility, and it becomes the yardstick for both signals and risk. If the ATR reading is invalid, the strategy does nothing. Next comes the core measurement, the lag-1 autocorrelation of the last 30 log returns, our coefficient rho. Alongside that, the strategy measures a recent directional impulse, defined as the change in closing price over the last 3 bars by default. That impulse is expressed in price units, so it can be compared directly against ATR. For the impulse to count as a genuine move rather than microstructure noise, its size must exceed a set fraction of ATR, 1/4 by default. This is a volatility adaptive gate. Now the decision. If there is a fresh, qualifying impulse, the strategy checks the regime. If rho is above the positive threshold, the market is persistent. It goes in the same direction as the impulse, riding the move. If rho is below the negative threshold, the market is anti-persistent. It goes in the opposite direction to the impulse, fading the move. If the reading is inside the dead zone, no position is opened. When a trade is opened, risk is defined immediately. The stop loss is placed at a fixed ATR multiple away from entry, 2 times ATR by default. The take profit is conviction scaled. It starts at 3 times ATR and grows with the strength of the correlation reading, so a higher confidence regime aims for a proportionally larger target. Stronger conviction, wider target. Finally, position management is adaptive. On each new bar, if the strategy is already holding a trade and the freshly measured regime now argues for the opposite side, it closes that position rather than waiting. Otherwise, it lets the stop loss and take profit do their work. This regime flip exit is what keeps the strategy aligned with the market's current statistical character. Let's look at the actual MetaTrader 5 code on screen, just as you'd see it in MetaEditor. At the top are the input parameters. CorrWindow, defaulting to 30, sets how many log returns go into the autocorrelation calculation. Impulse span, defaulting to 3, sets how many bars the recent impulse covers. Regime threshold, at 0.15, is the dead zone the reading must clear to declare a regime. ImpulseAtrFrac, at 0.25, is the fraction of ATR the impulse must exceed. Then ATR period, ATRSL multiple, and ATR type multiple control the volatility measure and the risk distances, and lot sets a fixed position size. In the middle block, the strategy sets 2 flags. Persistent is true when rho is greater than the positive threshold. Anti-persist is true when rho is below the negative threshold. Then, only if there is a fresh impulse, it assigns the desired direction. In a persistent regime, it takes the sign of the impulse, riding the move. In an anti-persistent regime, it takes the opposite sign, fading the move. The final block opens the trade. Notice the price is the ask for a long and the bid for a short. The stop loss sits at ATRSL multiple times ATR below the entry for a buy, or above it for a sell. The take profit mirrors that, at the conviction scaled multiple times ATR above for a buy and below for a sell. On the last 2 lines you can see both sides explicitly. Trade.buy is called for a long with the long comment, and trade.sell is called for a short with the short comment. Same structure, mirror direction. Now let's bring it all together on the chart. On top you can see the price candles, and in the panel below is our core measurement, the lag 1 autocorrelation reading, rho, which swings between the persistent zone above positive 0.15 and the anti-persistent zone below negative 0.15. Watch how the strategy switches its behavior as that reading moves. We begin on the left. The first couple of candles drift gently higher, and in the panel below the correlation reading is still low, sitting inside the dead zone near 0. Because the reading hasn't cleared the threshold, the strategy stays flat. It doesn't yet see a defined regime. This is the patience built into the logic. As the next candles print, notice 2 things happening at once. The candles start stepping up more decisively, each close building on the last, and the correlation reading climbs and pushes above the positive 0.15 level, into the persistent zone. That combination is exactly what the strategy waits for. The recent upward impulse now clears its ATR-based gate, and because the regime reads as persistent, the edge is to go with the move. At the buy entry marker, the expert advisor opens a long position, riding the impulse in the same direction as the trend. Look at how risk is framed the moment that trade opens. The stop loss is placed a fixed distance below entry, at 2 times the ATR, sitting just under the recent price structure. The take profit is set further away, at 3 times the ATR, and then widened by the conviction scaling, because the correlation reading here is strong. So the target sits meaningfully further than the stop, a reward-to-risk relationship greater than 1-to-1 before conviction, and wider still once conviction is applied. From there, the persistent regime does what its name suggests. The following candles continue to step higher, close after close, and price runs up into the take-profit target, where the long position is closed for a gain in this illustration. That completes the trend-following half of the switch. Now watch the regime flip. After the peak, the candles turn choppy, an up move followed by a down move, back and forth, and in the panel the correlation reading falls, crosses through the dead zone, and drops below negative 0.15 into the anti-persistent zone. The market's character has changed from trending to mean reverting, and the strategy adapts automatically. A fresh upward pop appears, one more push higher that clears the ATR gate. But this time the regime reads as anti-persistent, so the logic is inverted. Rather than chase that pop, the strategy fades it. At the sell entry marker, the expert advisor opens a short position against the recent upward impulse, expecting the move to revert. Again, risk is defined immediately. The stop loss sits a fixed ATR distance above the entry, just over the recent high, and the conviction-scaled take profit sits below. As the anti-persistent regime plays out, price rolls over and mean reverts lower, candle by candle, until it reaches the take profit target below, where the short is closed in this example. Notice what just happened. The very same rules produced a trend following long in one regime and a mean reverting short in another, purely because the correlation reading changed sign. That's the heart of the adaptive serial correlation switch. one measurement quietly deciding whether to go with the market or against it. And remember, this is a clean illustration. In live conditions, the reading can whipsaw around the threshold, impulses can fail their gate, and trades can and do reach the stop loss instead. This is educational information only, not a prediction of results. That brings us to the end of our walkthrough of the adaptive serial correlation switch. We covered how it measures the lag-1 autocorrelation of recent returns to classify the market as persistent or anti-persistent, how it uses a volatility-gated impulse to choose a direction, and how it manages every trade with an ATR-based stop, a conviction-scaled target, and an adaptive regime flip exit. Remember, everything here is educational information only and is not financial advice, a recommendation, or a solicitation to trade. Automated strategies carry real risk, and losses are a normal part of trading. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy analyses. You can learn more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.